About 6 months ago, I made a video breaking down how a dying software company turned itself into a giant leveraged bet on Bitcoin. The architect of that strategy was Michael Saylor. At the time, that take was unpopular. Since that upload, MicroStrategy's stock price has plummeted by more than 50%, wiping out nearly $100 billion in market cap. A few months later, I uploaded a second video evaluating the broader crypto industry. Since then, the global cryptocurrency market has shed well over $1 trillion in overall value. These massive financial losses reveal a severe structural fragility that exists right beneath the surface of the entire ecosystem. Bitcoin operates as the bottom block in a very tall, highly unstable game of Jenga that supports the rest of the market. Testing that foundation requires evaluating Bitcoin strictly against its original blueprint. When Satoshi Nakamoto introduced Bitcoin in the 2008 white paper, the instructions were specific. It was designed to be a peer-to-peer electronic cash system. This diagram outlines the 3 basic economic criteria required for any asset to function as money. It must work as a medium of exchange, a store of value, and a reliable unit of account. If Bitcoin cannot pass these basic economic tests, the trillion-dollar industry stacked on top of it is resting on a broken base. For a currency to act as a medium of exchange, it needs to be widely accepted for daily commerce. It has to work quickly at a busy retail checkout. This chart displays Bitcoin's processing capacity. Currently, the global network handles roughly 500,000 transactions per day. But when we include standard financial networks, Visa processes 65,000 transactions every second, clearing Bitcoin's entire daily volume in under 8 seconds. The issue extends to the intensive computational process required to verify those transfers, creating a massive carbon footprint for every single purchase. Processing one single Bitcoin transaction requires the same amount of electricity that an average American household consumes over 43 days. An asset that moves this slowly and consumes this much energy is unviable for commerce. It fails the first structural test of money. As these mechanical failures became apparent, the industry focus shifted toward Bitcoin acting as digital gold, an asset that functions like precious metals because of its strictly limited supply. This leads to the second test. A store of value is an asset that reliably preserves purchasing power over a long period of time, without severe fluctuations. This chart tracks Bitcoin's price performance. Instead of stability, we see extreme volatility, with the asset frequently swinging 20% or more in a single month. Volatility at that scale prevents businesses from planning their budgets and stops individuals from safely parking their net worth in the network. Because a store of value requires reliability, these erratic price swings cause Bitcoin to fail the second structural test. When measured against its original 2008 blueprint, Bitcoin fails the fundamental tests required to act as the money it was designed to be. Bitcoin's market price remains high, even though the digital asset completely fails to execute the functions defined in its original blueprint. When the technology fails to deliver on a specific promise, the narrative often pivots. When it failed as a cash system, the focus moved to digital gold. When the price dropped during high inflation, the story shifted toward a hedge against corruption. Since the core technology isn't meeting its economic goals, the current market valuation depends on the strength of these rotating stories. The foundational block of the entire crypto ecosystem is broken. The trillion-dollar industry rests on a base that doesn't function as intended, leaving a top-heavy structure waiting to collapse. If you spend any time online, you've heard the pitches. Bitcoin is digital gold. It's a decentralized revolution. It's the inevitable future of global finance. But before an asset can actually function as a true currency, it has to survive the strict, unforgiving math of classical economics. Economists use a specific framework to define money. As we can see in this structural breakdown, any viable currency has to pass 3 strict tests. It must act as a store of value, a unit of account, and a medium of exchange. We are going to strip away the memes, ignore the marketing campaigns, and look strictly at the real-world data to see how Bitcoin holds up against these 3 pillars. Because if it fails the foundational tests of money, we have to ask what is actually propping up its massive trillion-dollar valuation. Let's start with the first test, acting as a stable store of value. The popular narrative claims Bitcoin is a perfectly decentralized system, shielded from the control of traditional banks. The reality of its ownership tells a very different story. Looking at this distribution chart, roughly 2% of addresses control 95% of the entire Bitcoin supply. When ownership is this top-heavy, the market becomes intensely vulnerable. Prices can be easily manipulated by a small group of large holders. We saw exactly how fragile this makes things during the 2022 crypto winter. Trading firm Jane Street is currently facing a lawsuit for allegedly helping trigger that crash, an event that wiped out $40 billion in market value. An asset that is susceptible to this level of concentrated manipulation completely fails as a reliable place to store your wealth. That brings us to the second test, acting as a unit of account. This requires looking at how Bitcoin theoretically operates on the ground in daily commerce. Take a look at these local businesses promoting crypto acceptance. Even among merchants who actively encourage customers to pay with Bitcoin, the actual goods on the shelves are never priced in the cryptocurrency itself. Mechanically, every item is priced in dollars. The Bitcoin merely acts as a temporary pass-through, mathematically converted at the exact second of payment. Because it cannot act as an independent economic measurement and is structurally unsafe for storing wealth, Bitcoin has to rely entirely on the final test to justify its existence. The third and final test is functioning as a medium of exchange. And we don't have to guess what this looks like, because back in 2021, El Salvador ran the ultimate real-world experiment. The government engineered perfect conditions to guarantee success. They made Bitcoin legal tender, they mandated that businesses accept it, and they launched this official national digital platform, the Chivo wallet. To drive immediate adoption, they even offered the equivalent of $30 in free Bitcoin to any citizen willing to download and try the app. The primary target for this rollout was remittances. Sending money back home across borders without banking friction or massive fees was supposed to be the killer use case for a digital currency. But the international data tells a starkly different story. According to the IMF, despite the massive national push, Bitcoin accounted for less than 2% of El Salvador's remittances. 98% of people still opted to use the traditional financial system. User behavior data from the National Bureau of Economic Research is even more revealing. 60% of the users who downloaded the Chivo wallet simply cashed out their $30 bribe and never made a single subsequent transaction. Today, 66% of the population considers the Bitcoin project a failure. And as you can see from these protests, over 3/4 of the country wants public funding for the experiment halted entirely. If the public aggressively rejects an asset, even when its use is mandated by law and incentivized with cash, it comprehensively fails the test as a functioning medium of exchange. We are left with a very clear, undeniable reality. Bitcoin doesn't function as a store of value, unit of account, or medium of exchange. The economic foundations are simply not there. Unlike a share of stock in a business, it generates no cash flows. Unlike an agricultural commodity, it produces no physical goods. To understand what actually drives the price, we have to look at this cyclical flow model. It illustrates an old concept in finance known as the greater fool theory. The theory states that the price of an asset doesn't need underlying fundamental value to rise, as long as a greater fool buys it later at a higher price. When you look at the market through this lens, the hype starts to make sense. Every narrative you hear isn't a reflection of actual utility, it's marketing, carefully crafted to recruit the next wave of buyers into the cycle. But there is a fatal mechanical flaw in this system. The moment new buyers stop entering the market, demand vanishes, and the entire machine breaks down. Bitcoin is not a new era of global finance. It's simply the largest real-time experiment in the greater fool theory the world has ever seen. And eventually, the market will run out of fools.